Ladies and gentlemen, our next speaker has served as the Deputy Governor of the Reserve Bank of India. He has been involved with formulation of several major regulatory and supervisory policies for commercial banks and banking sector reforms in India. He also represented India on the G20 working group on enhancing sound regulation and strengthening transparency set up by the G20 in the wake of the financial crisis of 2008. Please put your hands together for our keynote speaker, Anand Sinha.
Members of the finance fraternity, delegates to the conclave, ladies and gentlemen, it is my pleasure to be here with you. I find that the theme of the conclave, innovation and emerging opportunities, is very timely and apt. Housing is a very important driver of economic growth due to its backward and forward linkages with a large number of industries and creates huge job opportunities besides providing a very basic need to the populace. The government's initiatives such as Housing for All by 2022 and push for affordable housing has given a major boost to the housing activities. The central government has implemented various initiatives to address the supply and demand side constraints, which include infra status to affordable housing, tax holiday to affordable housing developers for 5 years, ECB in affordable housing, credit-linked subsidy to economically weaker sections, low-income and middle-income groups, setting up affordable housing fund, and two important structural reforms, that is GST and RERA. All this will result in major push to housing activities and a spurt in housing finance. This is a space which is fiercely contested by banks, NBFCs, and HFCs, which should sharpen competition and incentivize innovation. For example, those who can innovate to build alternate credit risk models for segments for segments not having adequate financial records based on behavioral data or other parameters will have huge opportunities. In any case, innovation has to be an ongoing process to get competitive advantage as well as develop more customized and affordable products. One of the recent introductions in the Indian housing market has been the provision of mortgage guarantee, which is provided by the India Mortgage Guarantee Corporation, which is a joint venture that combines the development mandate of NHB, the technical expertise of Genworth Financial, and the resources of IFC and ADB. Mortgage guarantee allows mortgage lenders to mitigate their credit risk and thereby get release of capital which can then again be used for further lending, thus boosting housing finance. During the conference, we would be discussing in great details the various technical aspects of issues relating to housing finance, and I'm sure many good suggestions and actionable points will emerge. So I don't wish to engage with you on the technicalities because you know better than me. But what I want to talk today about is, from an institutional perspective, how you should try to be strong and not get into stress situations based on various experiences, because whether you do housing finance or whatever else you do, you need basically to be strong and sound. So that is the theme on which I am going to talk to you. So let's look at the Indian economy, which has moved away from sunny days to one of some concern rather quickly. The inflation, which has trended down in the near term, has even risk of trending upwards due to domestic as well as the global factors. A combination of volatile oil prices, rising US interest rates, a stronger dollar, and the intensification of trade tensions have already led to market pressures and capital outflows in some emerging market economies, including India. Quite a few see financial stability risk if the pace of rupee depreciation continues. To add to our woes, we have the recent phenomenon of liquidity and credit crunch affecting particularly the NBFCs, HFCs, and the mutual fund industry due to the happenings in the IL and FS group. In this background, I wish to talk about some, though not all, broader issues which concern how not to get in stress situations as far as possible. Of course, with the admission that there are exogenous variables beyond anybody's control. And should that happen, one should have the resilience, both in terms of corporate governance and buffers, capital buffers, liquidity buffers, to be able to survive the situation. And that is where stress test becomes an extremely important tool. A good starting point would be the assessment of global financial stability risk in the latest GFSR of IMF, a publication of October 2018. I quote, 10 years since the failure of Lehman Brothers, the global economy continues to grow and progress towards a safer global financial system. And this is undeniable. New supervisory and regulatory standards, tools, and practices have been developed and implemented across the globe. Banks are now stronger because the quality and quantity of capital has increased steadily, and minimum liquidity standards have been phased in around the world. Supervisory stress testing has been broadly adopted, and many jurisdictions now have macroprudential frameworks and policy tools with which to address systemic risks. Many shadow banking activities that contributed to the global financial crisis have been curtailed or transformed into safer market-based finance, unquote. It is clear that in this overall assessment, we are outliers today, though this was not the case till a few years back, despite the fact that we are in sync with Basel requirement for creating Basel III regulations. We have a macroprudential framework. In fact, we were one of the pioneers in macroprudential policies, as well as the Financial Stability Board framework for dealing with the shadow banking system. Now, shadow banking system, on the face of it, seems to be a negative term, but in reality, it is to be taken as something as a very important component of the financial system which needs to be strengthened and nurtured. That is basically the approach of the Financial Stability Board. And in any case, in India, we had that approach. And as HFCs and NBFCs, which are very active in the housing finance world, apart from banks, of course, banks not being shadow bank, not being a part of the shadow banking world, therefore I am not mentioning them. But as far as NBFCs and HFCs are concerned, how to deal with them in the wake of the financial crisis and the experience gained, or an international approach has evolved. We, in fact, in India, have had a long-standing approach to dealing with the NBFCs, HFCs, and other components of the shadow banking system. And in my view, that is much more robust than the international framework which has come up. Clearly, we have a lot to do for improving the robustness of the banking system. We have seen corporate governance failures, including ethical deficit, both in the public sector and private sector segments. The public sector banks require aggressive recapitalization and cleaning up of their books of toxic assets. The reform requirements are not limited to these two only. It's a very long list. The NAYAC committee proposals provide a robust framework. In the absence of any other competing model put forward for reforms, the NAYAC committee recommendations need to be implemented more aggressively. Let me spend a bit of time on the resolution of stressed assets. This is something which concerns every financial institution, whether it is a bank or a NBFC or a HFC. The IBC framework, RBI's circular of 12th February 2018, and the recent amendment to the Prevention of Corruption Act provide a very robust tool, a very robust set of tools for both creating a sound credit culture as well as tackle these stressed assets. The bankruptcy framework is one of the greatest reforms, but being new is beset with many legal issues and is not progressing according to the time framework. As per data which I saw somewhere, only 6 cases out of the 40 in RBI's 2 lists with financial debt of nearly rupees 1.25 trillion have got resolved, with a recovery of approximately 43% to the financial creditors. Over a period of time, the framework will surely settle down. But we have to ensure that unlike all the previous frameworks, be it restructuring, BIFR, DRT, SARFAESI, etc., it does not become ineffective and a victim of its own potential. And this will likely happen if, for seeking safety from investigating agencies, banks and other entities push nearly all resolution cases to NCLT. The pipeline will get so choked that even when the legal issues get sorted out over a period of time, the framework will not likely deliver quick and effective resolution. So this has to be generally a last resort, and the available mechanisms like restructuring, sale to ARCs or other financial intermediaries and OTS need to be explored first in the shadow of bankruptcy proceedings. The recent amendment to the Prevention of Corruption Act to the erstwhile archaic laws should embolden bank officials and other financial sector officials in taking this route. The essence is that contractual obligations for payment schedule of interest and principal should be honored. The leeway of 90 days given before the NPA classification kicks in is not taken as norm. Stress is detected at the incipient stage and corrective action taken immediately, depending on the viability of the project or the activity financed, and no attempt should be made to push things under the carpet. It is very obvious that banks should not punch above their weight. I am using the word bank, but that is equally true for any financial intermediary. That is, banks or other financial intermediaries should not undertake activities for which they do not have expertise. Unfortunately, this keeps on happening, and despite major setbacks, this pattern continues. Recall the derivative episode of 2006-07, those who can recall, when a potentially very large stress on the corporate and bank balance sheets was staring in our face due to improper use of complex derivatives, which neither the banks nor the customers understood. Many of the stressed assets today have been underwritten by banks who do not have any expertise in underwriting complex infrastructure projects. The responsibility to take up the financing, the kind of financing, lies with the board and senior management. What I mean is that if they know that they don't have the expertise in the bank, they should not undertake such financing. The root cause of why financial intermediaries do this is the competition in the system. Competition is an essential element of a market economy, which is needed for increasing efficiency and productivity. But unbridled competition can result in a downward spiral and in some extreme cases in a meltdown. Banks look up to regulators for saving them from getting sucked in the whirlpool. I quote from a book, On the Brink by Henry Paulson, Treasury Secretary when the crisis erupted. The setting is a dinner on June 26, 2007, just before the beginning of the financial storm, attended by Mr. Paulson and the heads of some of the Wall Street's biggest firms. I quote, all CEOs were concerned with excessive risk-taking in the markets and appalled by the erosion of underwriting standards. The bankers complained about all the covenant-light and bridge loans they felt compelled by competitive pressures to make. I remember Jamie Dimon, the JP Morgan chairman and CEO, saying that such loans did not make sense. Steve Schwarzman, the CEO of Blackstone, a dominant private equity firm, acknowledged he had been getting attractive terms and added that he was not in the business of turning down attractive money. Chuck Prince, the Citigroup CEO, asked whether, given the competitive pressures, there wasn't a role for regulators to clamp down some of the riskier practices. Basically, he asked, isn't there something you can do to order us not to take all these risks? Not long after, I remember Prince was quoted as saying, as long as the music is playing, you have to get up and dance. Now, generally, the marketplace leads regulations, and when activities, products get attraction due to competitive reasons, regulators step in, assess the risks, and prescribe a regulation around it or ban it. There are very few cases where the regulators take the lead and the market is behind. The outsourcing of containment of downside risks of competition to the regulators is a common phenomenon. But this raises a question about the risk management responsibility of the bank's board and senior management. Should not banks look at long-term value creation? And again, to repeat, the word bank includes all the financial intermediaries. Should not banks look at long-term value creation and refrain from destructive competition? While not all will subscribe to this viewpoint in practice, this is happily the case with some. In the context of the global financial crisis, the Senior Supervisors Group was set up by Basel Committee and the Financial Stability Board to look into why some banks did better than the others. And this report observed that the financial institutions which survived the crisis better were those who had, among others, informative and responsive risk measurement and management reporting and practices. The blend of qualitative and quantitative analysis provided a high level of insight and consistent communication to management of evolving conditions, enabling the firm to respond effectively to emerging opportunities and risks. Hence, there is a value creation if some more of our entities start to take responsibility of their own risk exposures and not leave it to regulators to stop them from getting sucked in unbridled competition. The short-term financing of long-term assets is an example over here. Now, before we take a look at our NBFC and HFC segment, I would like to talk a little about the global shadow banking system. The non-banking financial system, also known as shadow banking system, is defined as the system of credit intermediation involving entities and activities fully or partially outside the banking system. These entities resemble banks in their functioning as they carry out maturity and liquidity transformation and build up leverage. These entities have the potential to create financial stability risks but do not have access to central bank liquidity, lender of last resort facility, and we see that today it is in the center of, reportedly, I don't know, but reportedly, a reason for difference of opinion between RBI and the central government. They do not also have deposit insurance protection. This segment was either not subjected to prudential regulations prior to the crisis or was subject to regulation and oversight to a much lesser degree than banks. This was a conscious stance, as the ability of the shadow banking system to disrupt financial stability was not understood. The understanding was that if you control banks, you can control their interactions with other entities, and that should suffice. The largeness of the shadow banking system and the contagion potential obviously had been completely overlooked. Inevitably, the shadow banking system played a major role in the global financial crisis. The global approach to deal with this segment in the backdrop of the GFC has evolved based on the acknowledgement of their importance and relevance to the financial system. And this is what I want to emphasize, that though the term used is shadow banking, it is officially recognized internationally, and here in India we have been very particular to convey that this is a very important segment of the financial system. It is valued and it needs to be nurtured. And when people complain that RBI's regulations are going to in fact, people use the word kill them, the answer is that because RBI does value this component of the financial system, and that is why it tries to regulate them in a way that they remain resilient, though they have a lot of freedom. In fact, a very great amount of freedom vis-a-vis banks. They are the alternate source of funding for the economy. They improve the cost efficiency and provide diversification in the financial system and are source of financial innovation. Therefore, there is a need to ensure that there is oversight on this segment in a manner that it is resilient while limiting regulatory arbitrage. The approach that has evolved is to have mechanism to collect extensive data periodically, narrow down to the entities and activities where there is buildup of risk, and impose prudential measures based on proportionality, from a menu of options which are essentially the traditional tools. In brief, there would not necessarily be a system of structured prudential regulation on this segment, but would be devised and imposed based on risk perception as we go along basis. It is interesting to see the dimensions of this segment. The shadow banking assets at end 2016 at 160 trillion US dollars formed 48% of the global financial assets, and they were larger than the banking assets, forming 41% of the global assets. The banking system assets have declined for the 5th consecutive year, though banking system makes up the single largest share of the financial system in most jurisdictions. The shadow banking system in the emerging market economies, particularly China, has had much larger growth compared to advanced economies, resulting in the share of advanced economies declining over time. The segment, if we exclude insurance and pension funds, because they are also added to the shadow banking system. So, excluding insurance and pension funds, the size of the shadow banking system is 153% of GDP compared to the previous high of 139% prior to the global financial crisis. However, when drilled down to the entities and activities where risks on account of credit intermediation reside, the exposure shrinks to 45.2 trillion, or a reduction of 71% in the shadow banking assets at 160 trillion. Yet, for oversight purposes, data is required to be collected at a much larger scale, and the drilling down exercise is to be undertaken to arrive at the area of focus. In India, the shadow banking system, comprising largely of NBFCs, is much smaller compared to the banking system. The regulation of this segment has evolved over a period of time in response largely to adverse events, but occasionally there have been regulations put in place even without an adverse event. And one of the examples is that in 2006, the non-deposit taking NBFCs were brought into prudential regulations, which was very light earlier, on the consideration that because of their size, they can create contagion in the system. Today, there is much similarity with banking parameters, but still the regulations are far less onerous than that for banks. Overall, the structured regulations, to me, the kind we have in India, seem far better than as you go along approach of the FSB framework, because it requires huge collection of data, while serious data gaps exist and high degree of nimbleness in detecting buildup of risks which may not always be feasible. The happenings in the ILN-FS group can be attributed to highly inadequate corporate governance, general failure across the system in executing infrastructure projects, and funding of long-term assets by short-term money. This phenomena was at the heart of the global financial crisis, and yet it has not been taken with alacrity in the global framework for the oversight of the shadow banking system. We in India have also not imposed stricter liquidity regulations on the systemically important large NBFCs, though it has been done for banks. We now know that the short-term funding of long-term assets has become rampant of late in the NBFC and HFC segments, resulting in the credit and liquidity crunch due to panic reaction in the markets in the aftermath of IL and FS episode. Human memory is indeed short and is the cause of many of the problems in the financial world. Reinhardt and Rogoff, in their famous book, This Time is Different, 8 Centuries of Financial Folly, write, I quote, our basic message is simple. We have been here before. No matter how different the latest financial frenzy or crisis always appears, there are usually remarkable similarities with past experience from other countries and from history. Recognizing these analogies and precedents is an essential step forward improving our global financial system, both to reduce the risk of future crises and to better handle catastrophes when they happen. John Kenneth Galbraith, who was the US ambassador to India and a Harvard economist, he wrote a book on the 1929-1930 recession in US. And much later, in the foreword of another book he wrote, that book of mine, despite being so old, has never been out of print, because every 10 years something happens and people want to see what are the similarities. So this is about the fact that we keep on forgetting what are the pitfalls, and we repeat the same mistakes, but at the same time, there are institutions who guard against that. So it is not that in any situation, be it global financial crisis or be it today in India, it's not that every institution is in the same position. There are some who have managed themselves much better. And all that I have said is in that context. More and more should try and manage themselves much better and not flow along with the easier route, even though it is not prudentially sound. And they know it. It's not that they don't know that this is not prudentially sound. The consequences of liquidity, because liquidity is an issue, so I thought I should talk a little about liquidity. The consequences of liquidity deficit are far more serious than that of capital deficit. This is because capital, barring very exceptional situations, would deplete gradually, giving time for replenishment. Whereas no single metric would ensure sufficiency of liquidity. It is to be watched simultaneously and on many fronts. For example, an entity may hold, say, 120% liquid assets of net cash outflow during a month, which is a recently introduced measure for banks, LCR, known as LCR, liquidity coverage ratio. And yet it may not be able to meet its payment obligations if there is a spike of outflows on any given day, unless it watches out and is prepared for that. Similar difficulties can arise intraday. So there seems to be a case for tighter liquidity management at financial institutions of any hue, whose stress has the potential to rattle the markets and create panic, leading to liquidity and credit freeze. In fact, one could argue that all systemically important financial institutions whose stress has the potential to create panic in the financial system should be subjected to banking standards for systemically important banks, irrespective of their legal structure, an approach similar to that of USA under the Dodd-Frank Act. Another issue arising out of IL and FS episode in my mind is whether there is a need for conglomerate supervision for such large institutions. For example, the limit on leverage of 2.5 times imposed on the holding company under CIC regulations was of little use because the group, consisting largely of real sector entities, ramped up the group leverage to a very high 13. But it raises further issues. How does a financial sector regulator regulate and supervise a conglomerate consisting in a very large part companies from real sector? To my mind, the episode has thrown up some difficult questions which need to be debated and settled. I would sum up by saying, never waste a crisis. Thank you for inviting me for this conclave.
Thank you, sir. So may I request you to please be on stage for a little while longer? I would like to invite Arun Sharma, who is the Chief Investment Officer at International Finance Corporation, to present Mrs. Sinha with a small token of our appreciation. Thank you, gentlemen.